Today we are discussing Evergy Incorporated, ticker EVRG. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. This company has a market cap of $14.4 billion, enterprise value of $23.6 billion, and is an electric utility company. We can see in their business description that they engage in the generation, transmission, distribution, and sale of electricity in Kansas and Missouri within the United States. So their production comes from coal, hydroelectric, gas, uranium, natural gas, and oil, as well as solar, wind, and other renewables. Basically, they're all across the spectrum. They're not focused on a single production mechanism. They have 10,100 circuit miles of transmission lines. This is important because you get paid for both the transmission and distribution of electricity and gas in addition to the production, and so that's a valuable way of looking at the business. You have 1.6 million customers, including residences, commercial firms, so they're supplying both residential and commercial, and in, again, these areas, Kansas and Missouri. Beta of 0.5299, that's pretty low. The lower, a beta of 1 would be that the volatility of the stock is going to be about equal to the average S&P 500 company. At 0.52, you're looking about half the volatility. The lower this number is, it tends to be a better indicator of a quality, stable business, and we do see that as well when we go down to the return on invested capital chart. One thing I really like about this quickfs.net tool, of course, if you sign up, tell them you came from Trey sent you, and we see that they have had a profit every year for the last 19 years. You have 20 years of financials here. They did have a loss in 2002, but if we look since 2003, you have been pretty stably profitable. Two things are immediately noticeable here. One, the profitability for 19 straight years. Two, just the stability from year to year. This looks like a straight line. I've covered a lot of these companies, and you see these up and down cycles. You're not seeing that cyclicality here, and you really like to see that as an investor. The other piece, though, that you notice is that this is basically hovering around the 3 to 5% range. You see the 10% line here, 0% line here. You're right in the middle. Ideally, you'd be above the 10% line, but it's not uncommon for a utility company to be in this mid-single digit range. I'd like the number to be higher, but if you are in this range, the fact that it's stable from year to year is very important. 5%, 4%, 5%, 4%, 4%, 3%, 3%, 4%, 4%. Just look at the very small change from year to year. From 2012, you went from 4.51 to 4.51 to 4.61. Very, very little change. The less change you have here, the less bouncing around, the more predictable the business is, and the more reliable it is for managers to run the business. Makes it easier for them to manage. And also, it's more reliable for shareholders to predict out the future, and you really like to see that as a business owner from the shareholder perspective. Now, when we go down to our key statistics, we want to see a few different things. So you can see that the return on invested capital is 4.3%. It's being boosted to 8.8%. That's typically due to debt. You see this big gap between market cap and enterprise value. That's about $9 billion in net debt on the business. It's a significant amount. It's over a third of the total capitalization of this company is debt, and that's why they're able to take a 4% return on invested capital and bump it up to almost 9% return on equity. Now, I really want to see this in the double digits, ideally 15%, but it's not uncommon for a utility company be in this range. This is one of the better utility companies I've seen. Just this sheer stability here, as well as this number being closer to that 5% range instead of below that, you're in a much better spot for reaching your double-digit returns on equity, which is really a key tipping point for good performance as an investor. Now, the other thing that's really nice here is you see these revenue CAGRs at 10%. You're growing your revenue at 10% a year. A lot of these utility companies aren't able to grow that much, and this company is able to grow. Now, what I don't like is your assets are growing 12.6% while your revenue is growing 10%. You're growing about 2.5% faster on assets than revenue. What does that do? Well, it causes your return on invested capital to fall over time. You're solidly in this 4.5% range at the beginning of the last decade, and you're falling into the 3.5% range by the end of this year. And so you start to get just this deterioration in return on invested capital because you're growing your assets faster than your revenue and your EPS. It's not the be all end all, but it is something to be aware of that you're growing those assets so quickly. With that said, when you look at the gap here between 2017 and 2018 in revenue, you see a big jump. This suggests that you had a big acquisition in this 2017-2018 timeframe, which means you're going to have bought additional assets onto the balance sheet And some of this is likely goodwill. I mean, you see this 50% jump in gross profit. So you jumped your gross profit by 50%, but did you grow your assets by more than that? That would be a big player here. Some of those might not be tangible assets, and that can really affect your numbers. What I don't like to see here is this PE of 18.1. And it's less the PE, but more the price to book. If you need a 10% plus return as a shareholder, and the return on equity is less than 10%, that means you need to buy the company at a price to book of less than 1. And yet the price to book here is 1.5. I'd rather buy the company at a PB, price to book of 2/3 book, like 0.67, than 1.5, because that sets me up for this double-digit 12 to 15% return that I'm looking for as a shareholder. And when I'm paying above book, that's really your bad setup here. Now, price to earnings matters. I mean, the earnings are what really matter. But again, you're not getting this super cheap. The average company in the S&P 500 is going to trade for a PE of 15 on average across history. You're paying above average price here. This is probably a below average company with your return on equity here below 10%. You really want to see this in the double digit range. And so with that combined, you want to buy this at a PE of less than 15. You want to buy this with a price to book less than 1 in order to be really attractive, which means your share price needs to fall by a third probably to start to get into that range. You're at $63. That takes you down to $42 off the back of my head. And so you're just a little bit on the overvalued side. But again, I like the stability here in terms of the predictable nature of this business. The other piece here that you really like to see, though, is you see these dividends being paid each and every year. So you start out at $1.32 in dividends, you grow to $2.18. So you basically increased your dividends per share by 50% over the course of the next decade. That's not that fast. You're talking 5-6% growth. You've been growing about 6% at least for the last 5 years or whatever. So 5 to 6% growth per year. That's not great. It's not awesome. But the fact that you're paying those dividends while still growing these EPS at these rates is actually really attractive, because you're kind of combining that dividend growth rate with your future earning ability, because you're not having to reinvest all of your money back into the business. However, I do have a concern before even going to the income statement that we probably have some dilution here, and we're going to see that on the next tab. If you're enjoying this video, hit that like button. Don't forget to subscribe. We're working through every company in the S&P 500. Your subscriptions will let you know as I work through the rest of the stocks in the S&P 500. We've already done over 150 of them, so I hope you'll check that out. Now, income statement. Also, at the end of this video, we're going to have a link to the playlist where I've picked out the best companies I've covered from the S&P 500. These are my watch list companies. I think you'll want to see that playlist. Now, the revenue, again, we jumped up a big amount here, but that's not what I wanted to check on. I want to check on dilution, and you do have dilution. So if we go down here to the bottom, you see the shares diluted grows from 127 million to 230 million. Now, the big jump here is 2017 to 2018. That means that they made this acquisition with a dilution event. That's not ideal. Now, what you do like to see is, although they diluted you by a huge amount in that 1 year, you still grew your EPS year over year. That's a good sign. So the price that they paid was probably not way out of whack. So even though they created basically 50% more shares outstanding in a single year, they still grew the per share basis of the business because they grew their net income by more than they diluted you. So that's forgivable. But even after that, they still diluted you by another 15 by another 10% over the next 5 years. I mean, you're diluting a good solid 2 to 3% a year, and that's without even taking into account this 50% dilution over a single year. This is just a lot of dilution. You've almost doubled your share count over the course of a decade, which is just really high. And the problem with that is like, let's say you double your share count over a decade. That means you're growing your shares outstanding by 7% per year. Well, what do we have on our EPS growth? 7% a year. Basically, all the earnings growth is coming from dilution, which means your only return on a per share basis is going to be the dividends and the dividend growth rate. So you really need to do like a discounted dividend calculation based on this like $2 number, and then assume maybe a 6% growth rate, and that's going to give you a better idea of what you want to do. So how do we do that? Well, a 6% growth rate on a $2 dividend means that you can divide that, like let's say you need a 10% return. So you'd say, okay, 10% minus 6% gives you 4%. What's 4%? Well, 4%, if you divide this by 4%, it's kind of like multiplying it So basically you need to get it like a 4% yield. So multiply it by 25, so like $50 share price. Okay. So we're in the ballpark here. Again, $42, $50, somewhere in that range probably is where you're starting to get more of an attractive setup here. Now on the balance sheet, here's what I said. So you see this big acquisition. So they basically doubled their assets. And this is where the problem started. Because if you just look from 2011 to 2017, this is not a problem. The assets aren't growing that fast, especially compared to their growth in operating profit. They're doing quite well on doing that. The problem is this acquisition added a huge amount of PP&E. It did add a little bit of goodwill, but it's not as much as I thought. The main thing is they doubled their assets from 2017 to 2018, and yet they didn't double their operating profit. They didn't double their income. They did, they went up 50 to 60%, but they doubled their assets. So that's where you had that deterioration in return on equity because you had this reduced asset performance. It's not a terrible asset performance. It didn't go, through the floor, but it is a big setup there. Now, they did take on some more debt to do that as well, and they've continued to build this debt. They're not paying down debt over time, which is a little bit concerning. And you don't see a lot of retained earnings. I mean, you see this $2 billion in retained earnings. This is a $20 billion enterprise value company. So this business is being supported by debt and assets, and those assets are coming from stock. Not really the setup you want to have is having to issue a lot of stock in order to support the business, but it's not uncommon for a utility company to do that, issuing debt and stock. It's just something to be aware of. When you see this PP&E growth, that should be somewhat of a concern because what I see here is these numbers a lot of times exceed the cash flow from operations. So when your property, plant, and equipment investment is more than your cash flow from operations, and so this is 1 year, 2 year, 3 year, it's good there, 4 years, 5 years. So 5 out of the last 10 years. So every other year on average, your cash flow from operations is not covering your property, plant, and equipment. And that's before you pay dividends. That's before you issue stock. So you're in a really sticky situation that you're not able to grow without issuing stock. You're not really able to cover your dividend without issuing stock and raising debt. And so this is common for utility companies, but it's not this ideal setup for long-term double-digit returns. So for me, Evergy Inc. is a pass. I wouldn't put it on my watch list because I don't like the fact that they're unable to grow without issuing shares. They're unable to grow without taking on debt. They can't generate that growth from internal cash flows because these returns on capital are too low. Although they're stable, they're just not too low. If this number was 10%, this would be a totally different story. If this number was 8%, this would be a totally different story. At 8%, they could have internally justified the growth on their own. They basically just need this return on invested capital to get above your EPS growth rate, and they would have been in a really good spot. But because it's lower than that, that means they're having to force through dilution, they're having to take on debt, and that can't continue forever. Or at least if it does, it's not going to be good for you as a shareholder. So I'm going to pass on Evergy Energy. If you enjoyed this video, hit that like button. Please subscribe. Those are great ways to support the channel. Another way to support the channel is you can sign up for quickfs.net. My affiliate link is the first link in the description below. For your paid accounts, I love using this software. I think you will find use out of it too. Now, if you're enjoying this content and you want to check out my favorite companies, S&P 500, I have the playlist at the top right here on the video. So check out that playlist covering the best companies I've seen in S&P 500. And if you want to see the best video for you, it's the video here on the bottom. So check that one out as well. Thank you for listening. Until next time, stop paying fees, start building wealth.